And good morning, everyone. John Hutchinson and Jeff Wood along for today's Breakfast Club on Monday, June 23rd. It is 8:30 a.m. Eastern Time and probably 115 degrees if you live in the Northeast or Midwest. So keep the ice cubes close by. Um, I have a lot to cover with you today, and so we're not going to do a whole lot of preamble. Market is largely ignoring the activity over the weekend. Um, in the Middle East. So futures flat to open. That's fine. That's not unexpected. Jeff and I were just discussing, we don't really expect any major impact to the markets unless or until there's an Iranian response to the airstrikes and or some expansion of U.S. involvement that negatively impacts oil and or the Strait of Hormuz. So generally speaking for this week, the only thing that I really think folks want to worry about will be the first look at June manufacturing and service sector activity. That will be through the flash PMIs, which are out this week. Outside of that, this is known as silent week. This is usually the week of lesser economic data. So I'm not even telling you, didn't even put in a slide for it today. That's how quiet it is. But hopefully that will be of benefit to us, as last week was, as we'll go through in a minute on the weekly income report. Last week was pretty heavy in the rolling of trades category. Uh, and I'd like to see more of those trades be able to get closed out here in the week ahead. So not having that extra volatility impact right now, I think will be a good thing for you for your trades for the week ahead. So we can hopefully get more trades closed rather than trying to roll and carry too many trades in the next week or two, especially heading into the July 4th holiday and with earnings season directly following that. As you can see on the chart here, this is a weekly chart of the S&P 500. When I really want to get a better sense of where where the market is like whether the market is stuck, whether it's moving. I prefer to go to the weekly chart versus the daily chart because I get a better visual sense of what's taking place, what's transpiring in the stock market on a time basis. And you can see over the last 3 weeks, especially the last three candlesticks on the far right side or the hard right edge. We've had a real struggle with that 6,000 line in the S&P 500. 3 weeks in a row that line has failed. So that's a clear resistance line. So it's going to take some positive news for the market to break through and move higher. Now, that could be economic news. That could be the jobs report are coming in the beginning of the July. That could be surprising earnings in starting roughly the week of July, ending July 11. So there are conduits for the market to take that next step higher. Um, but we're also still sitting at a level below the January, February highs, which preceded all of the tariff noise, it's much clearer when you look at our weekly chart. You can see all the tariff noise. And we'll talk about tariffs here for just a second, not because they're critical or important, but because this confluence of tariffs and interest or inflation, rather. I saw a really good analogy over the weekend for it that I want to share with you, so you can have a better sense of how to attack the markets, how to think through what's going to take place in the next several months. I mean, obviously, we have the reciprocal tariff deadline, July 8, July 9 timeframe. So we need a decision on whether there are deals, whether that's going to get delayed further, et cetera. We have the EU tariff deal delayed. We have the not deal, but rather the tariffs being implemented on the EU with the China thing. I mean, there's a lot of stuff that's stacking up right now. And the way that the stock market is acting right now is essentially assuming good news. And so it's buying good news. And if there's bad news, then that's what would lead to the market reacting negatively. Um, However, the analogy that I saw this week, which I thought really made sense, is if you're familiar with horse racing, in the stakes, not in the stakes race, but in most of the claiming races, et cetera, there's what's known as a weighted saddle. And the weights in the saddle are intended to equalize competition among the horses in the race. So the favorite would carry a heavier weighted saddle, and the 100 to 1 long shot would carry either no weight or a very limited weighted saddle, right? So to balance out the competition from the best horse in the race to the lowest horse or worst horse in the race, the racing people used weights in the saddle. You can also do this. You can also see this nowadays in physical fitness, right? The fitness industry has moved to weighted vests. The idea of the weight is to uh, make it a little harder for that favorite to win the race, but not so hard that the favorite can't possibly win. So if you think of the economy, the tariffs are weighing down the economy just a little bit, but not enough to put the economy in a recession. Now that's a current view. That's the way that Wall Street is looking at the impact of tariffs, at the 10% global tariffs, as just weighing the economy down a little bit. Conversely, on the inflation side, and the analogy is filling a beach ball with air and then holding it underwater. If you've ever played in the pool, when you try to hold a ball underwater, eventually the ball wins, right? The air and the air pressure forces the ball back to the surface. That is the inflation pop that the Federal Reserve is anticipating. But what the Fed doesn't know is how much of a pop is that going to be? Is it going to be a tenth of a percent, couple of tenths of a percent, et cetera? So on the backside of last week's Federal Reserve FOMC meeting, one of the key things that the Fed is saying is we don't know what that pop is going to be. And they want that to have a better sense of how to handle interest rates in the quarters, months, years ahead. So this wait and see approach is still projecting a September rate cut. That could be brought forward. One of the Fed governors, Waller, had said that the Fed could cut rates as early as July. So that's possible, not likely, but possible. This week does have Jerome Powell speaking to Congress. So I don't think we'll get any more insight than what he gave in his press conference last week following the FOMC meeting. So don't expect much. But one of the other big questions that is beginning to hang out there, which should be revealed during July earnings, is whether retailers and/or businesses have, in the short term, been eating the initial tariff costs, the increase, whatever they're importing from around the world. Have they been eating that cost rather than passing it along to consumers? And if that is the case, and we don't really know yet, but if that is the case, how long is that sustainable? One earnings period, one quarter isn't going to answer that question, but it is a question to monitor. And as select companies from different sectors and different industries begin to report earnings in this quarter and in the next quarter, to see in their conference calls whether they are pointing to impacts to the cost of goods sold, so to speak. So this is sort of a really good way to look at where things are right now, and it helps you to understand better why this chart looks the way that it does on a weekly basis, why we've had a fairly rapid, sizable V-shaped move back to near all-time highs. I believe the all-time high is roughly 6150. So we're still 150 points below the all-time highs. That's a 2.5% move on the S&P. Good news. Any good news economically can certainly move the market back above that level. But as it stands right now, 3 weeks in a row the S&P has failed at that 6,000 line. That is the level to start watching. And we'll take a look at some other things with Jeff here in just a little bit. But a quick note, last week I showed you leading sectors year to date. Excuse me. And our top sector was basic materials last week. You can see a little bit of the impact of the sideways market last week with the basic materials falling below utilities. and the top spot. Let's look at the bottom chart down here. You can see, come on. So utilities takes over the top spot, but the one that caught my eye was communication services. Yeah. Communication services was number three and fell all the way down here. Lost just about 2%, a little just over 1.7%, lost 1.7% in the week. I think a lot of that was due to Apple following their WWDC conference. So I wouldn't put too much stock in that, but the comm services has been a leading sector for almost 3 years. So don't be surprised if it pushes right back higher. That is an area that I would be looking to attack for trade ideas and or stock ownership ideas because comm services has done really well. You can see technology continues to be down toward the bottom, and consumer cyclical is the 100-to-1 long shot carrying the heavy-weighted saddle right now. So as we'll look at some more sector data, some more chart data here in just a couple of minutes with Jeff. Before we get to that, I want to take you through last week's weekly income report. As I said just a minute ago, we had a lot of rolling, so a fair amount of delayed action taking place across the key services. So let's start with Income Masters for the week ending June 20th. We closed 2 trades, and the average days in trade for those 2 trades was 8. So they were pretty quick trades. That's a good thing. $8,800 in capital represented by those 2 trades, $382 net income, and a 4.7% return on capital. So a pretty light week compared to several of the weeks prior to that, where we were typically running roughly $1,000 per week. So you can see the impact of a slowdown in the market, forcing us to defend or manage positions out a little bit longer. You can see we had 7 positions that were rolled for the week between Vertiv, Occidental Petroleum, CF Industries, CRM, Salesforce, Block, Lulu, and the GLD. We added 4 new trades last week in the SMH, the VanEck Semiconductor Index, XOM, ExxonMobil, Amgen, and NVIDIA. And we also had an additional $162 in income on top of the 382 for a covered call for CCI, Crown Castle Industries. If you are in that perpetual income trade, we had a covered call close at the end of the week last week. And so your net income would have been $544 for if we were including that. When we get through into July, we'll begin building in the PI, perpetual income results into the actual weekly results because we want to make some changes to those stocks, sort of reset the perpetual income part of the Income Masters portfolio. So quieter week, busy, but quieter in terms of closes. Millionaires Trading Club, however, was a little bit busier by a whopping 1 trade. So 3 trades closed for the week. Average days in trade on those trades was 7. Total capital, $7,245. Net income, $1,440. The majority of that, over $1,075 of that was on our Russell 2000 RUT trade that worked out perfectly. We had a trade close on GE Aerospace and NVIDIA. So overall for the week, a 19.8% or near 20% return on capital for the week. We did have to continue rolling both Berkshire Hathaway B shares, B class, and Apple. Though, Jeff, I know you're chomping at the bit, hoping that you get a favorable open and maybe exit that Apple trade with a profit. And finally, for the SPX1, we had net rolls last week, negative $4.20. We had the payout premium again last week. Not a disaster, but the challenge when you're defending a trade sometimes, thing to keep in mind is it can get you wind up having to pay sometimes to get yourself in a more favorable position to be able to close. We have the puts and calls are essentially overrunning each other right between the 5,900 and 5,950 levels. So we'll see. We have I believe both have likely action to take today. So we'll just keep our eye and see what we're able to do. Depending on the market being flat, we may be able to roll an additional time or 2. But we're getting pretty close to the end on this trade. So don't be surprised if by the end of this week or next week, we are finally out of this. from February 20th. So current premium net accumulation is still holding at $9. That's including the $4 net debit that we took last week across these 6 contracts. So for the week, for the 2 main services, Income Masters and Millionaires Trading Club, 5 total trades closed, $1,822 in income on $16,000 in capital, or an 11.3% return for the week. So good week, even though we had to delay income on a fair number of positions. But I think, again, a good week this week should get us somewhere. 40 trades closed since we began Breakfast Club with you. So we're racking them up. 24 days in the period, $8,557 in total income since May 27, the week ending, the week beginning May 27, excuse me. Total capital represented by those trades. Look, that's not all still in play. That's just capital that was used across those trades in different time frames. It was over $93,000, giving us a 9.2% return on capital in the less than 30 days. It's pretty strong given where the market is. So with that, Jeff, let me turn things over to you. I will stop the share and let you take us on our way with your insight.
All right. Good morning, everybody. How's everyone doing? Everyone from the East Coast, or is there anyone from the West Coast calling in at 5 in the morning?
No chance.
Stalling. Hey, Brad Lowen is always on. So
no, Brad would be doing the dishes right now.
Really, what I'm doing is I'm just trying to stall until I can get my screen up. All right, everyone should see. There we go. Economic calendar. So as John mentioned, we have a little bit of a light week this week, even though it looks like it's a lot. As far as what I'm seeing, there's not too much going on. Again, we have Fed member Waller speaks. Well, that was 3 in the morning, so that's gone. We do have the flash PMI and services that John talked about. But again, anything over 50 is expansion. Yes, the previous report was 52. This is 51.1. Not a big deal. Flash services PMI coming out at 945. Again, slightly lower than the previous, but still above 50, which is showing expansion. That's what we want to see an economy going. That doesn't mean that this is the perfect timing to go bullish or anything like that, but it's at least, that's kind of the things that we're looking at to see if there would be a major recession or anything like that. So far, as long as they're above 50, we're in good standing. Again, John mentioned this one, Fed Chair Powell testifying Wednesday at 10 o'clock. Again, everything should be known at this point. And we've seen this before. John and I've seen this before. John and I've talked about this before with everybody. Even when things are known, and Powell says the same thing he's been saying for years, or at least months, sometimes investors take what he says and they run with it in a different way, or they think that he's all of a sudden going to say something else, even though he's telegraphed what he's going to say for months in advance. So I don't really expect anything to come out of this Wednesday at 10 o'clock, him testifying, but you never know how people are going to react. So there might be a little bit of added volatility around that, especially if you're doing 0 DTE trades or anything like that. You might want to be aware of that. Again, more of these reports, it seems like it's a busy week, but it really isn't. Final GDP numbers quarter over quarter, again, not showing anything different. Unemployment claims muted, 245 to 247, all fine. What we're really looking for is about a 4-week moving average of unemployment claims to be above 400,000. That would show a possible recession, even though we haven't really been talking about recessions for a while. So, tariff or anything else that you want to talk about, the unemployment claims, 4-week moving average of unemployment claims, not really moving that much. They're creeping higher for sure, but nothing to expect this week, really. And again, all of these other ones, these yellows, which are not as important, they could still always move the market. But if you look across the board, there's really not that much change, with the exception of durable goods orders looking to increase from the previous month's report. But for the most part, everything is pretty much falling in line with forecasts. So the only thing that would be a surprise this week would be if something really moves beyond the forecast, then we could see a major move. But right now, we don't really have any catalyst events. As John talked about, really the only catalyst event that we have would be the 4th of July weekend. We have anything with the Middle East, but we don't really, we don't have earnings for a couple more weeks. So likely to see lower volumes of trades. I'm sorry, lower volume in the market overall, as hedge funds are, out and enjoying their summers. Hedge fund managers are out enjoying their summer. So I would expect lower trading volumes overall going into the 4th of July weekend, and which I know is still a couple of weeks, but still got to start talking about it. And then we'll just kind of see where that goes from there. All right, so as John talked about, he talked about sector performance as well. And the communication services over 3 months, very strong. Over 1 month, also strong. So yeah, it had a little bit of a hiccup last week. Google is facing some regulatory issues. Google's facing lawsuits. They're also facing competition from things like ChatGPT. So Google's sort of driving things down. Apple had a muted response at best from their WDC, their World Developers Conference. Market wasn't too impressed with the products that they're rolling out. So that kind of helped drag communication services down. But the other one, information technology, had a really good strong 3 months, had a really good 1 month, and also over the last 5 days, not much going on there. So of the sectors, now we're going to talk about energy in a second. Energy is certainly going up with the Middle East news, but of the sectors, if you want to start concentrating in and honing in on certain sectors, information technology, communication services, which is a little tech heavy, but those are areas that I would be looking into for the upcoming trading week. Now, as far as some other chart that I like to look at is the percentage of large cap stocks moving above their 20-day or moving above their averages. But what I actually zero in on is this column here, the 20-day moving average. And you can see energy is right now the strongest sector with 96% of their stocks trading above their 20-day moving average. So you might think, well, okay, that energy is a really strong sector right now. That's where we should be looking at trading this week, and certainly with the Middle East and whatever else. But I'm going to show you in the slide, for those who maybe haven't followed me or have not been in one of the other services that I'm in, I'm going to show you why I would actually stay away from energy right now. And it doesn't mean that there's not going to be strong sectors within energy that will continue. I'm sorry, strong stocks within energy that will continue to go up. There's certainly news-driven reasons why certain stocks within the energy sector may continue to go up. But it's usually at these points where 80% or more of stocks within a sector are trading above their 20-day moving average. That usually means that that sector overall is a bit overbought and looking for a pullback. So that is why I'm not too keen on energy at the moment. Again, we talked about information technology and communication services. Only 57% of stocks trading above their 20-day moving average and 61% of information technology. So that what that tells me is only slightly better than half of the stocks within those sectors are trading above their 20-day moving average. So either we have a few stocks that are really bringing up the entire sector, or what that's saying is that there are many other stocks within that sector that will that have room to grow. And so if you're looking for trades and you're looking to find alpha, if you're looking to find where that performance gain is going to be, then I'm going to start looking at strongest sectors, but I'm also going to look at sectors that have room to grow or have stocks within that sector that still have room to grow. So those are kind of the two sectors that I would look at. However, I'm going to show you another chart that shows that maybe there's some concentration in other areas that we may not be looking at based on just purely looking at this chart. So before I do that, this is kind of what I was talking about with energy. This is the if you chart out, if you go back a slide, and if you actually chart out this 96%, you do it on a daily basis, you get something like this. And this is the S&P energy stocks trading above their 20-day moving average. And this is, again, why I tend to look at things when, and this is an oscillator. It goes from 0 to 100. You can either have 0 stocks in that sector trading above their 20-day moving average, or you can have up to 100 stocks. So we're range bound from 0 to 100. And you can see I've highlighted this line in red at the 80 mark. And so when the energy sector, and really this applies to just about any sector, when that sector gets above 80, again, XOP, some of those other stocks, some of those really, really strong stocks within that sector might trade above their 20-day moving average for weeks or months. But overall, when the entire sector has too many stocks trading, 80% of their stocks trading above the 20-day moving average, that tends to lead, we had this period here, then there's a pullback. We had this period here, pullback, here, this period here. I mean, geez, that gap down from like 95 down to less than 20. So, so it tends to say, the amount of move in that sector might be slowing down. So even though that's a very strong sector right now, and there are stocks within that sector that you might be looking at saying, oh, I want to get in on this with the Middle East crisis or whatever. I'm just saying the energy sector overall might be a little bit overdone. So I take that and then I also say, okay, well, what was the percentage change from week to week? So overall, the S&P 500, even though it had sort of that flat week that John showed on his chart, it's been flat for a couple of weeks. The number of stocks trading above their 20-day moving average actually jumped by 14%. So that shows that there's some momentum there. We just need that catalyst. We need something to sort of like really, head up to all-time highs and beyond. But at least what we're not seeing week to week is we're not seeing that number go down. So again, that sort of neutral-ish area that John was talking about. Consumer discretionary actually had one of the bigger jumps at 57%. So which just means, this was trading at like 30-ish or 20, in the 25-ish percentage of stocks trading above their 20-day moving average last week. It jumps up, so that's a 50% gain. And then financials, that one jumped up quite a bit. That was really, really low last week. Jumped up 236% change week over week. And then there's the other ones, communication services, still looking strong. So then what I was starting to look at is like, okay, is there something within consumer discretionary? Is there something within financials that we could potentially trade? Is there something within communication services? So some of these, as long as it had a positive number, I was looking to see if we could find a trade or what kind of stood out there. And I'll get to that in just a second. Then as far as headline news goes, if there is any retaliation, Iran said that there would be, but so far market is pointing at a muted open. I would see a potential for a volatility spike, but I would also see that to be short-lived. So take advantage of those trading strategies that are looking for volatility spikes or reduction in volatility after an event. So those can be your bull put credit spreads, do bear call credit spreads if you really think a stock's going to go down as well. Some of the other ones, calendars and diagonals, also work well going into a volatility spike. So if volatility hasn't spiked yet or doesn't look like it's going to at the open, but maybe it will with the anticipation of retaliation, then maybe a calendar or a diagonal is a strategy for you this week. As far as short-term stuff, if you're worried about the anything going on with the Middle East, you can always look for defensive plays in your gold and silver, your commodity plays. Defensive stocks right now, actually Northrop Grumman, Lockheed Martin, some of those would be interesting this week. And then oil and gas, not my personal favorite, but if you want oil and gas and you're really worried about some sort of blockage, or you're looking about, increase in oil prices or anything like that, then FANG, XOP, stocks like that might be your go-to this week. But again, as I mentioned, I'm not too much of a fan of energy at the moment. All right, so as far as scanning for stocks, so what I did was I took 2 slides ago and I took those sectors that had positive momentum, and then I looked for stocks that are currently trading below their 20-day moving average, but still trading above their 20-day moving average, because I'm looking for stocks within those sectors that are likely to move up with the rest of the sector. Concentrated just for this particular scan on US stocks. I also, from what I've learned from John over the years, positive EPS growth and positive profitable price to earnings. I looked at mid cap stocks and then just high volume. I think it was 1 million shares. I wanted to make sure that it was a pretty liquid stock. And actually, the only 2 tickers that came across would be were DCM, DXCM, and Mastercard. So Mastercard MA, that's in that financials. So that one kind of stood out to me a little bit more. Now with pre-market pricing, I can't really look at this, so I don't know if this is going to work or not. But what I'm looking for is to take advantage of some bullish momentum into the week. And so this would be a very short duration, a 1-week trade, bull put credit spread. Normally when we do some of these things, we look for, a 30 delta or a 15 delta to put our sold strike. Well, with this one, I'm being a little bit more aggressive. And I would look for a short strike just underneath the 200-day moving average. I'm assuming that these stocks are in a sector with bullish momentum. These stocks are trading above their 200-day moving average. They have positive EPS growth and everything else. They're just, right now below their 20-day moving average, waiting for that turnaround. So in this case, especially with a 1-week trade, I'd be a little bit more aggressive on the deltas and put the short strike underneath the 200-day moving average, assuming that the stock would have a bounce off the 200-day moving average. You can concentrate your entries however you want. That's just kind of what I was looking at for 2 trades this week. But whatever that ends up being, so Mastercard is pretty much sitting at its 200-day moving average. So you would put the if you're doing a bull put credit spread, and I can show you all this in the chart in just a second. You'd be putting your sold strike pretty much at the money. But one way of, if you do that, you're going to at least get 25% of credit in the width of the strike. So if you do a 1 wide, you need to collect at least 25 cents. If you do a 5 wide, you need to collect at least $1.25. And if you're putting the sold strike at like a 40 or a 50 delta, then chances are you're going to get at least 25% width of the strike. Some people might not like that and say like, oh, there's no room. But again, this is, this is having some conviction on direction. All right, so with that, I'm going to go to, give me a second, and I'm going to go to some charts, and we'll look at some charts, and then we'll get you out of here for the day. So I just need to find my Zoom controls. All right, so now by now you should be able to see Thinkorswim. So again, actually, we had quite the change. I've been tracking futures overnight. We were almost down at one point last night. We were down by 0.3%. Now we've flipped positive. So the market really just does not seem to care about bombing Iran. So I guess that's not too bad of a thing. This is a weekly chart of the S&P 500 using SPY. And if you for those who maybe have not followed me for very long, you know that you may not know that I use Hutchinson candles. Hutchinson candles, I can flip between them. But if you kind of have that in your Heikin-Ashi candles, it's I'm not going to get into that today, how they're calculated. Although if you send me an email, I can tell you all that stuff. But what it really does is it smooths out the trend. So, red is a down candle, green is an up candle. This is just normal candles on a weekly basis. If we go to our Heikin-Ashi candles, it just kind of helps smooth out the trend and give us a better, clear direction of where the market might be going. Now you can see from a Heikin-Ashi candle perspective, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 green weeks. And if you go back through history, we've had 3 and then a red. We had 5 red, whatever, 1, 2, 3, 4, 5, 6 red. Here's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and then a red. So we're at 10, and we've not yet seen a red candle. So this is kind of what John was talking about before. We've also hit this all-time high was 613.23 on the SPY. We're not coming up to that point. We're sort of looks like we're rounding out on the curve a little bit. We do have some higher highs and some higher lows, except for we have not beaten this high. So intra week, we've had higher highs and higher lows, but we still have not yet taken out this one. And if this does round out and curl back over, then now all of a sudden we have a lower high than what we had back here. So something that we just need to be very careful and keep watching. But as far as the Heikin-Ashi candles go, we do have bullish momentum, but this has now been 10 bars, and you can see that the average is certainly less than 10 bars, and the most that we went back about a year looks like it was about 12. So it doesn't mean that we can't get a few more bullish bars out of this, but we just need to be a little bit careful about where we are. Now, if we can go to the daily chart, this is again Heikin-Ashi candles. You can also see the waves of the market a little bit more clearer, and you see the last 3 days we actually flipped to red Heikin-Ashi candles. So the momentum on a daily bar level is a little bit low. We have our low here, which we bounced off of the 20-period moving average, and now we are up here. So we'll see kind of where a pullback might happen. I've highlighted in these gray boxes some zones of interest for me. So if we can get support in this gray box, that's great. Then maybe we do go up and challenge all-time highs up at this level. We would do, something like, something like that. We'll see if that takes hold. If not, the next sort of area of interest I would be looking at is this 586 level. And if that happens, let's take this. Let's see, show label always. That's about a 2.5% pullback from where we were mid-June. So we'll see, where that happens. But again, this first gray box is that sort of high that we had back in middle of May. So if we find support there, great. If not, I would at least look for a 586 pullback. But we do have some definite resistance here. And actually that kind of goes back to some muddied area that we had back in January and February of this year. Is this sort of flat area. We tried to break out of that and then immediately went down. So we're in that same sort of area where we're just trying to find a bullish catalyst to break through. And if not, then expect a little bit of a pullback. Let's go to Qs. Very similar situation. We have this this area where we've had resistance before. Yes, we did have all-time highs, kind of broke out there in February, but pulled back right after that. So we're kind of in that same area again. Technical analysis isn't always perfect. The levels aren't always black and white. They're kind of more zones. And so if you look at this zone, you know, this is an area of resistance at this point in time. So if we get some sort of bullish catalyst, we can break through that. But right now, this is acting as an area of resistance. Do I think, you know, we go all the way down to 510 on the Qs? Maybe not. Certainly there is this area that we could highlight as well as a potential support area. So if we do have a pullback in the rest of the market, you know, maybe Qs go down to 520. The issue with all that is I actually think it's going to go more sideways unless something happens. So unless there's some sort of news-driven event that happens, I think we're more sideways. Seasonality shows that 10 days prior to the 4th of July weekend, trading volumes go way down. And the market actually does tend to have a historical up record for the 10 days prior to the 4th of July weekend. Is that going to happen this year? Don't know. But I don't see this major pullback unless something happens. I think it's more just sideways movement. Maybe we kind of come up and try to tackle some old highs. The other interesting thing is the VIX. I mean, absolutely nothing. It's still fairly anemic, trading at 21.13. This is only up 1%. I know the market hasn't officially opened, but still very low compared. I mean, we had, you know, way more in tariffs. I think what this is showing is that most investors think that the bombing is a one-off and that we're not going to put boots on the ground or anything else. So still pretty anemic there. However, we are trending a little higher over the last couple of days. So volatility is expanding slightly, but it's still pretty low. And if you look at things like gold, gold pulled back the last couple of days, but still on a very strong uptrend. Hasn't really broken out. This is the 50-day moving average. I mean, there's, oops. It's following a trend line very well. So if we can get down to that trend line and then pull up, I don't see why gold won't continue to go up. Now, as far as the two stocks that I was looking at was Mastercard. Let's go back to a normal candlestick. Oh my gosh. So here's the 20-day moving average. We are trading below the 20-day moving average. We had actually quite a big move in Mastercard on 617. And then it was trading right at its 20-day moving average. So maybe that is, you know, maybe you don't like the way that the chart looks. But again, financials having bullish movement in that sector. So what I was kind of looking at is this is currently trading at 532-ish. That's right where the 200-day moving average is. So what I'd look for is the 27 June. Now, you know, this might be, oops, what did I just say? It's 532. That might be a little aggressive, but if we did the 530 by 527.50, that's a 2.5 spread. And if I go back to my PowerPoint, the 2.5 wide to get 25% of the width of the strike, it's a 2.5 wide spread. I need at least 62 cents. So if this holds up at market open, you can get down to that 530 strike. We're currently trading at 532, and you'd pick up 25% of the width of the strike. Now you can go the 527, 525. So if you want to give yourself a little bit more room for the stock to go down, that's still currently pre-market price showing 75 cents. And again, you're looking for at least 62 cents or higher. So that's that one. And then DXCM. Let's go year to date. This is currently trading above its, oh, interesting. Why is that? Oh, this is 50-day and 200-day moving average. Sorry, this is, we can edit that to be 20. All right, so there we go. There it's under its 200, under its 20-day moving average, above its 200-day moving average. So let's see, 76 is where the 200-day moving average is. If we go out to a 1-week chart, 76, yeah, is we'd have to really wait until the market's open. This is showing a 0 to $1.60, 165. So bid-ask spread not where it needs to be. All that sort of craziness. We'll see. We'll see what happens when the market opens to see if that's a trade. But what I would look for is, you know, $1, $2 wide trade. And again, picking up 25 cents on $1 wide may not seem like a lot, but that's 25. It's really 25% in 1 week. So not too bad. And then putting it down at the 77, that's assuming that this stock would, you know, pick up support around 76, 70, you know, 76, 77, somewhere in there on the sector that that is increasing. This stock is just having a little bit of a pullback. Now, if you don't like the look of the chart, that's fine. I totally get it. This is just one of those thinking in advance, you know, in being a contrarian when everyone else says, oh, this is a stock to sell. This is looking at other things around that that stock that might lift it higher, and positioning yourself where the credit is worth the risk. But with that, it's kind of what I wanted to talk about today. Is there anything?
Jeff, I
Yeah.
have a quick question for you from Charles. It says, do you utilize level 3 book viewer or find it useful for how we trade?
So I got to be careful on how I say this. I have nothing wrong with it, but I don't personally use level 3 book viewer. What I have done before, and I wouldn't say that I utilize this regularly, but in TradeStation, if you trade with the dome, or you know, which is your like futures trading, you can actually see volume in like iceberg levels. So I don't use the official one. I just use the dome on TradeStation, and we'll look for volume levels. The other thing that I do is it's not the same, so I don't want to confuse things and say it is remotely the same. But I use I'll look for icebergs, if you will, on open interest on options. So, you know, and I'll look for areas that will likely be defended. So on the put side, the areas with the highest open interest aren't always defended by major institutions, but those are levels that are of interest that'll help guide you. And if you use Fibonacci's and all the rest, you know, it usually kind of tends to coincide with high open interest levels. So this, you know, 595 is an area of interest. This 590, which also tends to be these big round numbers, the 595, 590, you know, 585. I mean, that's where most people are going to be trading at those big numbers. But so maybe SPYs, you know, if we look at Apple, you know, this 195 area, 190, those are kind of the areas. So anyway, it's a long way of saying I don't use that specific program, but I look at things similar to it.
All right, looks like that's it for this week's Breakfast Club. We'll be back next Monday, just before the 4th of July holiday. So we'll keep our eye on what's transpiring during the day today, and hope you got some ideas out of today. Next week, we'll also be looking at how to set up a laddered put hedge. I still see some down movement potential, as both Jeff and I have talked about. So this is a trade that we gave out, what was it, 2 summers ago? We did this,
something like that.
and we did really well with it. I mean, we didn't make, it's not like we made millions, we didn't, but we made, you know, it was anywhere between 50 and 100% return on a debit options trade. So we'll take a look at how to play the backside of the S&P next week, next Monday, and how we do with our trading for this week. So we'll see everybody in Income Masters at 12:30 today, and hope you all have a great week, and we'll see you again next Monday. Thanks, Jeff. Thanks, everyone.